These are some example problems from chapter 18 of your text. The first one that we have is departmental allocation to profit, departmental cost allocation to the profit centers. And the first one I have is number 18 29 on page 806 of your text. It says Elvis Wilbur owns two restaurants, the Beef Barn and the Fish Bowl. Each restaurant is treated as a profit center for performance evaluation. Although the restaurants have separate kitchens, they share a central baking facility. The principal cost of the baking area include depreciation, maintenance on the equipment, materials, supplies, and labor. And then we have four requirements here. Number one, Elvis allocates the monthly cost of the baking facility to the two restaurants based on the number of tables served in each restaurant during the month. In April, the costs were 24,000, of which 12,000 is fixed cost. The Beef Barn and Fish Bowl each serve 3,000 tables. How much of the joint cost should be allocated to the Beef Barn? Okay, so um, now you probably can figure this out just intuitively because it's 50-50, right? They each serve 3,000 tables, so we're going to split it $12,000 a piece. But let's go ahead and do it methodically. So we have 3,000 tables divided by a total of 6,000 tables times 24,000. That equals 12,000. And then the same thing on the other one, 3,000 divided by 6,000 times 24,000 equals 12,000. So that's requirement number one. Then requirement number two says in May, the total fixed and variable costs remain the same. So it was 24,000, 12,000 fixed. But the Beef Barn served 2,000 tables and the Fish Bowl served 3,000 tables. How much should be allocated to the Beef Barn? So in requirement two now, we have 2,000 divided by 5,000 times 24,000, and that's going to equal 9,000. Excuse me, 9,600. And then for the Fish Bowl, we're going to have 3,000 divided by 5,000, 5,000 total tables, times 24,000. And that will be 14,400. Assume that Elvis decides to use a dual allocation approach in which variable costs are traced directly to the user based on the table served, and fixed costs are allocated evenly because, on average, the two restaurants have equal activity levels. Assume the same table service outcomes in requirement two. Okay, so now it says that the fixed costs are allocated evenly, so each one will get 6,000 because the fixed costs are 12,000, and then we will get 2,000 divided by 5,000 times 12,000, and that will be 4,800. That'll be 10,800. And this one will be 3,000 divided by 5,000 times 24,000. And that's going to equal 7,200. And so the Beef Bowl will get 10,800, and the Fish Bowl, Beef Barn, excuse me, and the Fish Bowl will get 13,200. So that would be requirement number three on that. And then requirement 4 just says, why would managers of the beef barn and fishbowl be upset about the cost allocations in requirement 2? Well, because it's going to when they have a good month, it's going to drag down their profits because the fixed costs are pretty much set. But in this case, it wouldn't be quite so bad because it says that they use it evenly throughout the period. But so anyway, that's number 8-29. And then the next one up is number 18-30. And on 18-30, we have the allocation of marketing and administrative costs to profit centers. The Chilton Day School allocates marketing and administrative costs to its 3 schools on the basis of each school's annual tuition revenue as a percentage of the total. Last year, the allocations in thousands were as follows. The preschool got 275, the middle school got 325, and the high school got 400 for a total of 1,000. In the current year, the middle and high schools experienced no change in revenues, but the preschool's tuition revenue increased to 1.9 million. Marketing and administrative costs rose to 1,250,000. So now we've got the preschool, we've got the middle school, and we've got the high school giving us the total. All right, so the preschool was 1,900,000, the middle school was 1,800,000, and the high school was 2,200,000. And so that would be 5,900 or 5,900,000 in total. Okay, and so now our total administrative costs were million 1,250,000. So we're going to have 19,000 divided by 59,000 times 1,250,000. And so that one will be 402,542. Okay, the middle school will be 1,800 divided by 5,900 times 1.25 million. And that'll be 381.35. And then finally, the high school is 2,200 divided by 59,000, 5,900 times 1,250,000. And that will be 466 for 102 for that. Okay, so that'll be the cost of each of those. All right. The next one up is number 18-36. And 18-36, we're going to do a cost allocation on a cab share. Suppose there are three passengers sharing a single cab ride, and passenger A's fare to his destination would be $12. Passenger B usual fare to her destination would be $18, and passenger C's fare would be $30. Because they are sharing the cab and assuming no surcharge, the total cab fare is $30 rather than the $60 they would have to pay in total individually. So there is a $30 savings to sharing the cab. So 18-36 asks us then to assume the passengers to decide to split the $30 savings based on the relative proportion of how much each passenger would have to pay individually if they had not shared the cab. How much will each passenger pay? Okay, so they would, the first one would have 12 divided by 60, right? The $12 charge divided by the $60 total charge times the $30 payment in total would be 1/5 or $6. Passenger number 2 would have $18 divided by 60 times 30. And let's see, it would be 30%. That would equal $9. And then finally, we have 30 divided by 60 times 30 would be 15. So that's how much each passenger would pay under that system. So basically, each one got cut in half. Number 2 says instead that the passengers decide to split the cab fare so that each passenger saves the same absolute amount of money. How much will each passenger pay? Well, the total savings is 60 minus 30 is 30, right? 30 divided by 3 equals $10 a piece. So 12 minus 10, passenger A would pay $2. 18 minus 10 would be $8, and C would be 30 minus 10 would be $20 on that one. Explain how you would split the total cost of the cab fare and why. Are there other ways that could be sensible and or fair? Yeah, fairness is just depends on how you see the world, and so there are other ways you could split it up. Um, um, you know you could split it up based upon how much they make. You could split it up based on who gets reimbursed and who doesn't. There's just all sorts of different ways that these things could be split up. Personally, I would, assuming that we're all paying out of pocket, I would prefer myself the first way to do that. Yeah, so that's just a personal choice. Okay, our next one. Okay, is 18-42. And on 18-42, we've got Kate's Kale Chips produces a healthy snack made primarily of kale. Each bag of product sells for $5. The company computes the manufacturing overhead rate on a quarterly basis based upon the planned number of units to be produced that quarter. The following data are projections of Kate's Kale Chips for the upcoming quarter. We're going to sell 20,000 bags. We're going to produce 22,000 bags. The variable cost per manufacturing is $2. Sales and distribution cost per bag, that's also a variable cost, is 15 cents. Total fixed manufacturing overhead is $33,000, and the fixed administrative overhead is $18,000. Compute the projected cost per bag under full costing. Okay, under full costing, what we do, our product costs, we're going to take the 22. The product costs here are the variable manufacturing costs and the fixed manufacturing overhead. So $2 a bag times 22,000 bags is 44,000, and then we have 33,000 in fixed manufacturing overhead is 77,000. We then divide that by the number of bags produced. $22,000 is $3.50 per bag. Compute the projected cost per bag under variable costing. And then under variable costing, the cost per bag is going to be the $2 plus 33,000 divided by 20,000. Oops. Is $1.65, and that would give us $3.65. And variable costing, the product costs, product costs are included in the product costs or the fixed costs are period cost, and so we include all of it in the cost of goods sold. Okay, number 18-43. Start Me Up Inc. manufactures a caffeinated energy drink that sells for $4 each. The results for the first year of operation appear below. There you have it. Number of drinks produced, 52,000. Number of drinks sold, 50,000. Direct materials, 55 cents. Direct labor, 25 cents. Variable manufacturing overhead per drink, 15 cents. Total fixed manufacturing is 39,000, and total selling and administrative costs are 50,000. And then it asks us to compute the operating income for the year under full costing. Okay, so this is 1843. All right, under full costing, couple of different ways you can go about this, but the probably the straightforward way is to take 52,000 and just add all of our variable manufacturing costs together. 55 and 25 and 15 would be 95 cents. And 52,000 would be 49,400. Add our total fixed manufacturing, which was 39,000. Gives us 88,400. Divide that by the 52,000. Gives us $1.70 per unit. Okay. And we want to compute the operating income. So we were told that each drink sells for $4 a unit. We sold 50,000 of them. Would be 200,000. And we had 50,000 times $1.70 would be 85,000. And so this is our gross profit is 115,000. Subtracting now our fixed selling and administrative costs were 50,000. Gave us 65,000. Okay, and this is our operating income. Okay, and this is under full costing. Under variable costing, we treat fixed costs as that period, as a period cost. So our revenues stay the revenues. We have 200,000, but now we have 50,000 times 0.95 would be 47,500. Would be 152,500, and this is our contribution margin. Right, and now we subtract our fixed costs of 39,000 and our selling and administrative of 50,000. And when we do that, we get 63,500. All right. So as you can see, under full costing, our income is higher than under variable costing. That won't always be the case. The rule of thumb is if inventory goes up, because we made 52,000, but we only sold 50,000, our inventory went up. If inventory goes up, full costing will give us a higher income number. If inventory goes down, then full costing gives us a lower income number on that. Yeah, that's assuming that the costs remain the same from month to month. So what's the reconciliation on this? They asked for the reconciliation. because what you've got here is the 39,000 in fixed cost divided by the 52,000 that we produced. And that's going to be 75 cents per unit. We take the 75 cents, 75 times the 2,000, and that's going to be 1,500, and that's the difference. Okay, well, where did that 1,500 go? It is under full costing, it's stuck in ending inventory in those 2,000 units, and under variable costing, it shows up as a period cost. All right. Number 1848 is strategy and the balanced scorecard. And this is our last one. Fowler's Farm is a 1,000-acre dairy and tobacco farm located in Southern Virginia. Jack Fowler, the owner, has been farming since 1982. He initially purchased 235 acres, has made the following purchase since then: 300 acres in 1985, 150 acres in 1988, dairy equipment and buildings worth $350,000 in 1988, and 350 acres in 1998. The cost of farmland has inflated over the years, so that although Jack has a total investment of $1,850,000, the land's current market value is $2,650,000. The current book value of his buildings and equipment Net book value of his buildings and equipment is $300,000, with an estimated replacement cost of $1,250,000. Current price pressures on farm commodities have affected Fowler's Farm as well as others across the country. Jack has watched as many of his neighbors either quit farming or have been consolidated into larger, more profitable farms. Fowler's Farms consists of three different operating segments: dairy farming, tobacco, and corn and other crops intended for livestock feed. The dairy farm consists of 198 milk-producing cows that are grazed on 250 acres of farmland. The crop farm consists of the remaining acreage that covers several types of terrain and has several types of soil. Some of the land is high and hilly, some of it is low and clay-like, and the rest is humus-rich soil. Jack determines the fertilizer mix for the type of soil and type of crop to be planted by rules of thumb based on his experience. The farm equipment used consists of automated milking equipment, 6 tractors, 2 tandem axle grain bed trucks, and numerous disc plows, wagons, and assorted tractor and hand tools. The farm has 3 equipment storage barns, an equipment maintenance shed, and 90,000 bushel grain elevator dryer. The equipment and buildings have an estimated market value of $1,500,000. Jack employs 5 full-time farm hands, a mechanic, a bookkeeper, and has contracted part-time accounting tax assistants with a local CPA. All employees are salaried. The farm hands and the bookkeeper make $25,000 a year, and the mechanic makes $32,000 annually. The CPA contract costs $15,000 a year. In the most recent year, the farm produced 256 gallons of raw milk, 23,000 bushels of tobacco, and 75,300 bushels of corn. Jack sells the tobacco by contract and auction at the end of the harvest. The revenue this year was $1,345,000, providing Jack a net income after taxes of $233,500. Jack's daughter Kelly has just returned from college. She knows that the farm is a good business, believes that the use of proper operating procedures and cost management systems could increase profitability and improve efficiency, allowing her father to have more leisure time. She also knows that her father has always run the farm from his experience and rules of thumb, and is wary of scientific concepts and management principles. For example, he has little understanding of the accounting procedures of the farm, has not participated in the process, and has adopted few, if any, methods to maintain control over inventories and equipment. He has trusted his employees to maintain the farm appropriately without using any accounting or operating procedures over inventories or equipment, preventative maintenance schedules, or scientific application of crop rotation or livestock management. Okay, so prepare the balanced scorecard for Fowler's Farm. Okay, so in our balanced scorecard, we have 4 categories. The first category is financial. The second category is learning and growth. The third perspective is the customer perspective. And the fourth is internal business practices. Now, let me look real quick to make sure your book uses those terms. That's common terminology. But some authors use just that. Goes all the way back to chapter 2. Yeah, internal. I say customer satisfaction. I use customer perspective. Internal business processes. I use internal processes. Learning and growth. Okay. So the financial perspective, there's a number of different ones that you could use. Most people will use net income, but so that's the most common. But some alternative ones that you can use is return on assets, revenues, various things like that. Now, I'm going to go with net income because the farm is established. Lots of times, if you have a new business, the revenues will be appropriate because you want to see that the business is growing. That's what you have to be careful though when you do that because I can be the world's largest seller of Mercedes Benz. All I have to do is get a contract from Mercedes Benz to buy they can ship me, and then go out and sell them for $20,000 a piece, and I'll be the world's greatest seller of Mercedes Benz, right? But I won't make any money because they're going to cost me more than $20,000 each. So you have to be a little bit careful with revenue, but revenues is a good one. That return on assets is particularly useful when you're trying to compare different size, either businesses or whatnot. You know, if you were to compare, for example, Target to Walmart, right? Walmart just dwarfs everybody in the retail space. So you look at return on assets and that sort of thing. It would be a good way to compare things. And then learning and growth. In this one, I'm going to say that learning and growth, the would be um, our yield per acre / cow. Right? Are we getting better at managing that kind of stuff? Customer perspective. This one is kind of difficult in the agriculture area because one of the complaints of the ag industry, going all the way back to Frank Baum and the Wizard of Oz, is that farmers are price takers. They don't get to set their price. Very few farmers get to set their price. And we're seeing a little bit of that with these, um, like these direct from farm steak places and stuff like that, where they're now getting to set a little bit of their price. But customer perspective, um, such things as number of complaints, repeat business. Repeat business and customer complaint is probably not um, appropriate in an agricultural business, but I'm going to go with uh, number of defects. So, if we sell some milk and it's rejected, if we sell tobacco, it's rejected, something like that. And then internal business practices will be our cost of operations. So that would be a balanced scorecard in this case. All right. So that gives you an example of some problems from chapter 18.